if you're only going to hold the property for a year or two and you do the cost seg and you don't do a 1031, or you're not going to do let's say an opportunity zone type investment after that, then it probably won't make sense because the tax code's going to grab back or claw back some of that depreciation you took early. As you hold it longer and longer, the recapture bite, which is what that's called, starts to mitigate over time, because either way you go, straight line or accelerated, you're going to have recapture.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Welcome back to the Real Estate Pros Podcast. I'm Cody Crabb with Investor Fuel. Today I'm joined by Jeff Hyatt, the Depreciation Doctor. Jeff helps real estate investors legally reduce their income taxes. Through accelerated depreciation, and he brings a rare mix of deep cost seg experience plus real-world investing perspective. Love a good real-world perspective. So Jeff, thanks so much for joining us today.
Hey, well, thank you, Cody. Thanks for having me on. I'm glad to be on Investor Fuel. I'm looking forward to today's conversation and can't wait to dig in a little deeper here.
Fantastic. So my first question is, we have a lot of newer investors. Just real quick, could you give us an example of what cost seg is in just quick terms, so we can so our audience is kind of on board as you're telling your story?
Sure, no problem. So the way that it works when you buy real estate is you're automatically going to be pushed into either 27.5-year depreciation or 39-year depreciation. That's what the tax code will kind of default you or push you into. What a cost seg says is, wait a minute, there are parts of the tax code that incentivize real estate investors to take advantage of the tax code and accelerate the write-offs so that they can take pieces of their building more quickly without having to wait 27.5 or 39 years to get it. You get to take it over 5 years, 7 years, or 15 years. And with bonus in play, they get to take it even faster. So that's what we help our clients do. And we have been doing this since '96.
Awesome. So let's with that in mind, let's get a little bit of your background. How did you get into this industry? What do you provide for people? Kind of what caught your attention about real estate and this in particular?
Well, back in 1999, when I joined the firm, there was only 2 people in the firm at that time. We started in '96, but I joined in '99. With that said, I was working with some franchise restaurant owners, big donut coffee shops and pizza shops and taco shops, and was working with them. And all of a sudden, cost seg became a really big topic, meaning accelerated depreciation. I didn't even think it was a big deal until I started to talk to these clients, and they were very excited about it. So that was in '99. We started to do seminars for CPA firms in '03, and our business shot through the roof because all of a sudden the CPAs out there realized that the first opening for cost seg started in 96, and they hadn't really done much with it.
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
And then the CPAs that dealt a lot with real estate owners said, this is really huge. We need to bring it out to our clients. And that's what they started to do. And we became their go-to cost seg providers. And we've been doing it ever since. We started out, back in the day doing 5 or 10 a year. Now we do 1,500 to 1,600 studies per year with our 38 employees doing the site visits and all of that stuff. So it's become a big operation. We've got 6 satellite offices across the country. So we've got a nationwide reach, and we can do almost any type of property from little Airbnbs to skyscraper buildings. And we've done them already. We've done about 27,000 studies.
Wow. Okay. Well, so with that kind of experience, I mean, it seems like you really start to understand this strategy very specifically. So one question I'd have is, so when does cost seg make the most sense for an investor? When is it like not like maybe you shouldn't, but you should pivot a little bit away from that?
Well, you kind of have 2 windows open on the computer screen there. One is when should you do it, and the other is when should you not do it. So when you should do it is anytime you're going to hold the property for, say, longer than 3 years, and or even less time if you're going to do a 1031. So there can be stacking of benefits here. So if somebody's going to buy a property and hold it for at least 3 years, but they won't consider a 1031, or that's just not in their mindset, then probably less than a 3-year hold doesn't make sense, but more than a 3-year hold will make sense. And so the cost seg can really help out there. And if you use it in tandem with, let's say, a 1031 or an opportunity zone subsequent investment, life can be really good then. But there are some times that, the typical standard buy and flip person that's coming in, buying a property, putting some paint on it, and then selling it shortly thereafter, cost seg won't help them there because they're going to have to give back so much in a thing they call recapture. But the bottom line is, if you're doing 1031 or opportunity zone investments, it can work very, very nicely there.
And you mentioned a 3-year hold window, yes?
I did, yes.
So can you kind of break down why that matters so much, and kind of what consequences are there if you end up having to sell sooner?
Well, so that's a great question. If you're only going to hold the property for a year or two and you do the cost seg and you don't do a 1031, or you're not going to do let's say an opportunity zone type investment after that, then it probably won't make sense because the tax code's going to grab back or claw back some of that depreciation you took early. As you hold it longer and longer, the recapture bite, which is what that's called, starts to mitigate over time, because either way you go, straight line or accelerated, you're going to have recapture. The bottom line is you just want to understand that going in. So we tell people if they're not going to hold the property for 3 years or longer, that probably doesn't make sense to do a cost seg unless 1031 is on the table. The biggest mistake that people make is that they're often not taking advantage of this early enough, because what this concept will do for them is help them build their wealth, build their real estate portfolio more quickly. So versus waiting 27 and a half years or even waiting 10 years, they can grab the deduction now, reduce what they have to send to Washington, D.C., and redeploy that money and buy their next property more quickly. Or they can use that money that was going to go down to DC. Now they get to use it and fix up their current property and they can charge a higher rent potentially.
Yeah.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency, it's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Yeah. I mean, wow, that's kind of interesting. So, I mean, because you've kind of done so many studies around this, I'd be kind of curious about your perspective. Like, are there certain property types where like things really are like, oh, this makes, the savings make the most sense here, or like they surprise people because it's just kind of, I'm curious how it differs.
Well, ultimately, when you boil it down, the cost seg is going to make sense on almost any property once you get over a kind of a certain threshold. And what we find is that it'll make sense looking at the fee versus the benefit once let's say the purchase price is north of 300 grand.
Hmm.
If somebody's buying a really small property, really low basis, really low purchase price, and they're not spending a lot of money to fix it up, probably they're not going to be too excited, about saving 5 or 7 or 10,000 bucks. But bottom line is, once you get above that $300,000 threshold, typically almost everybody will be excited about those tax benefits there. And that's what we find, and that's often what we'll steer clients towards is also another thing that they want to look out for or make sure that they're going to be in a high enough tax bracket to fully utilize the tax benefits that the cost seg would bring them. In other words, if they don't have much income for a given year, we would say, hey, don't do this right now. It's not a
Hmm.
good time for you. Because bottom line is, if you're in a really low tax bracket, then you're going to burn up the depreciation in a good in a low tax rate year, that if you waited a year or two when some of those sales of your other real estate have occurred, you could use it in a better tax year a year or two from now. So we try to help the client not just do, the cost seg because that's what our business is, to sell cost segregation services. We don't want to do that if it's not going to help the client most beneficially.
Hmm. So, I wonder, like I said, because of your background, you had this cost seg experience, you had this real estate investor experience yourself. I'd be curious to know a little bit about your real estate investing experience and how that kind of affected your investing. Did you change what properties you invested in because of that?
Well, it's kind of funny how it happened. I was talking to so many real estate investors, and I kind of came to realize, hey, these people are no smarter than me. I'm not dumber than they are. Literally, I was thinking, if they're making money at this, I can do this too. And so my wife and I started to buy properties, and she
Wow.
ended up becoming a real estate professional. So she manages our portfolio, and we have kind of a smattering of almost everything, because oftentimes the clients that I'm dealing with will have a portfolio themselves, and they'll be in the process of getting rid of a particular property, or thinking about getting rid of a property, or they'll know of one that they're not going to buy, and they can say, hey, Jeff, this might be of interest to you. You want to take a look at it? And so we've kind of done that over time, and just acquired everything from multifamily, single family. We own retail properties, triple net
Huh.
retail properties. So we've got a smattering of a little bit of everything.
Gotcha. Okay, so let's kind of make this a little bit more practical. So let's say I hear this. I'm a newer investor, and I say, Jeff, this is all great. Who doesn't want to save on taxes? This is all awesome. Where the heck do I even start with this? Like, what is step one if I want to kind of start looking at making this a better situation?
Better situation to reduce your taxes.
Yeah, that's what I
Probably,
meant.
yeah. So probably, I would say for a lot of people, and I'm not going to call it um, training wheels, but I'm going to say it's a good starting point for a lot of people that may not have real estate professional status acquisition right away. They may not be there yet. But if they were to use short-term rentals, because short-term rentals you can get into, you can rent them typically for more than you might be able to rent a long-term rental for. And
if you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
any of the income is going to come into you, but the loss is from a cost seg. So the combination of short-term rental and cost seg give that owner, that short-term rental, person, it gives them the losses, and not if there's excess loss, in other words, excess deduction from the property they just bought, they get to use it not only against income from the short-term rental, but also from their day job income. So even if they're an attorney or a doctor or the plumber, whatever they are, if they're using the short-term rental advantage. Now, some people on the social media out there call it a loophole, but it's not really a loophole. It sounds sexy to call it a loophole, but
Like
it's
you're
really
getting
not.
one over on them. Yeah,
Like,
I know what you
exactly.
mean.
That's
Yeah.
that, and so that sells, as they say.
Yeah.
That becomes the headline, the loophole. But it's part of the tax code. So
Yeah.
I don't really call it the loophole myself. I call it the short-term rental advantage because it's an advantage. It's part of the tax code. When a lot of CPAs see the word loophole, they get freaked out and they immediately start to hit the brakes. So I tell people it's an advantage, not a loophole.
So the reason you frame it like that is because you feel like people, if they think they're doing something like that's a loophole, they could get caught, or that it's risky when it's technically totally legal. It's just that it's something that you have to take advantage of intentionally instead of just by accident.
Right. It's oftentimes it's not the number of deals that people do. It's that they get to use what the tax code incentivizes. And that is a big incentive out there. And if people don't know about it, or if their advisors think it's some sort of a scam loophole thing, the brakes are going down. But it's not. It's just part of what the tax code allows.
Yeah. So for somebody, and like you said, for somebody newer, like the short-term rental can be much more accessible entry point, because it gives you kind of the income potential here, and then the tax potential over here. It kind of, it's like a double-sided, and it's not a full-time job to run a rental. I suppose it depends on your clientele, but
Well,
I
on
see
that
what you mean.
note, with the short-term rental advantage, you do get to use it against your day job income if you're actively managing it. So that doesn't mean you have to be there full-time, 24/7. You don't have to be there like pulling all the weeds and everything, but you've got to have active management in it. But as long as you've got that active management, as long as you've got the active management and everything, you're good to go, and it will work against your day job income, which is a big advantage, because if you had that same property and it was long-term rental, i.e. an apartment, then it's not going to give you the ability to write off your day job income as well, whereas short-term rental advantage does.
Gotcha. Okay, so tell us a little bit more about the Depreciation Doctor. Why is that your why is that your handle? And kind of is it? Tell me about it. I just want to know about it.
So, thank you for asking that. So, shockingly, a lot of people might consider taxes and this whole topic to be exceedingly boring.
You've got to be kidding me.
No,
Taxes.
I know. There you go. I'm putting it out there. Spoiler alert.
On April 20th. Yeah.
Well, we were very popular last week, but the reason I went with that kind of fun name was because it does shut down people's brains when you say, oh, we talk about taxes and everything. So I kind of went with Depreciation Doctor because it's not only just cost seg, but like we've already talked about, you've got
Yeah.
short-term rental that you can use against your day job income. You've got 1031. We talked about that. There's partial asset dispositions, which is taking write-offs and other things. So there are a whole lot of different tools that come together. And when people understand that it's not just the cost seg, but it's optimizing what they're able to use, these tools are really not aggressive. They're simply allowing you to use the tax code as fully intended when those tax laws came into place. So
Mm.
we don't just work on cost seg, we help the client's overall portfolio and their position to reduce the tax bite to help them grow generational wealth more quickly.
Awesome. Yeah, and I don't think anyone here would complain about that. So my question for you is, let's say someone's like, okay, Jeff knows what he's talking about. I want to work with him. Where do you have to live? Who do you need to be? Who's an ideal person to work with you?
So we're all over the country. So I'm kind of the depreciation doctor. Typically, the information would come to me, and then assuming that the client makes sense. So what we always do is offer a complimentary estimate of tax benefit and our fixed fee quote. That's one
Mm.
of the things you want to watch out for out there are people that talk about a percentage of savings. That's not allowed in the tax code for this type of work. So
Mm.
we always work on a fixed fee quote, but we tell people up front, we would say, hey, Cody, you bought that property 3 years ago, or 7 years ago, or 10 years ago. You can step back in time without amending your tax return and grab those deductions currently. So you get to take that deduction now that you missed 5 or 7 or 10 years ago. So we'll give you that estimate. And you can get me through the contact information here on the website or all, which is real easy to get to. I'm depreciationdoctor.com and happy to give a complimentary meeting and talk through everything for the client.
Fantastic. Well, thank you so much. I like how you kind of frame this around like timing and strategy. I think it's so helpful. Not just go get deductions. It's like that's what you usually hear from, it's a strategy. Tax strategy is called that for a reason. So, thanks so much for giving us this kind of detailed explanation that. Like I said, some people kind of just hear taxes and glaze over a little bit. So the fact that you can explain it in this way in just this little snippet, I really appreciate it. Everyone, go visit Jeff on the website. Make sure you get in touch. Oh, sorry. Did you want to say something?
Oh no. We've got we'll offer a nice course. We can offer
Mm.
kind of a mini course, so like a 15-minute scenario if they want to kind of go through that, and we can help them overall. And it's really just if they want to understand, does cost seg make sense for them or does it not make sense? Because we'll help them either qualify, make sure that it is going to make sense for them, or we'll disqualify and say, hey, listen, Cody, it would be better for you to wait a few years to use this because you're in a low tax bracket, or you're not going to have whatever benefit this year versus a couple years from now. So we help people with that.
Yeah, great. Well, thank you so much. I think people are going to really appreciate this. Jeff, can't thank you enough for joining us and giving us some time today. I appreciate you joining us. And you, listeners, thanks for joining us as well. If you liked what you heard today, go ahead and visit us on YouTube and follow us on Apple Podcasts or wherever you get your podcasts. Leave us a review, a comment, a like, subscribe, whatever, all the things so you don't miss more content like this one. Once again, Jeff, it's been a real pleasure.
Thank you, Cody. Thank you very
Yeah.
much for having me on
Yeah.
today.